The first thing we want to talk about are some policy changes. And uh, I've got this slide up here about change and uncertainty. And the first thing I want to do with everybody is acknowledge kind of the unease everybody is feeling right now. Let's be honest about it. Change is hard, and drastic change is even harder. And it tends to create a lot of uncertainty. It's very unsettling. And despite where you land on the political spectrum, change makes people nervous. And we've seen some pretty dramatic changes come down in a very short period of time. So I think you've all seen some version of this kind of chart before, and it usually relates to our feelings about the market, but it could also relate to our feelings about things in general. And I think it's important for us to understand change and uncertainty and put it in a little bit of a perspective for right now. Because I think that no matter what, you do experience various emotions when you're going through change and things seem to be more uncertain than at other times. But without uncertainty, returns would be predictable. Life would be kind of boring. I mean, after all, it's that whole thing with mountains without valleys. There is a difference in when uncertainty presents itself in the kinds of returns that you get in markets. And that's why investing in the stock market pays a higher return than in a savings account, because you are taking risk, because there is uncertainty in those markets. And that's why you're rewarded when you invest in markets. So I think that's important to keep in mind. There's always that risk reward aspect to things in the stock market as well as in life. And as recently as 2022, we saw the market went down a huge amount, and then by 2023 it was way back up again. So this potential for risk makes possible the potential rewards. And what makes it a little more difficult as humans is that it's our nature to perceive loss as far more intensely than we perceive joy when times are good. So we remember the crash of '08 or the market decline during COVID far more intensely than we remember of all the many fantastic years in the market that we've had over the last decade. And so because we feel the loss more deeply, I think it tends to affect our judgment. And it's due to that kind of intensity. And the same is true when we're talking about change and uncertainty in life in general, because it's throughout our lives, with our health, with our families, with our country, our politics. There's a lot of uncertainty surrounding us right now. And just like we can't control the weather, we can't control what's happening right now. And, all we can do is kind of mitigate the circumstances as they relate to us. So, if you think it's going to rain, you're going to take an umbrella. If you think it's going to snow, you're going to wear a parka. And you kind of weigh the risk of having to carry that umbrella around if it doesn't rain, or carry that parka around if it doesn't snow as heavily as you thought. But yet it's a way that we can mitigate that kind of risk and that feeling of having no control over our circumstances. So with that in mind, I want to look at some and just a few of the policy changes that may have a direct impact on your portfolio. I certainly can't go through all the changes because we don't have 3 days here, but we can at least start with the ones that I think will have the biggest impact. The first one is immigration. So I think it's important to look at the impact of immigration on a very broad view, because it's important to remember that unauthorized immigrants make up about 4% of our workforce across all industries. So the macroeconomic impact of this crackdown on immigration may be moderated a bit by the fact that that percentage is fairly low. I think that, this talk about deporting millions of undocumented immigrants may not come to fruition, but it's the fear of that crackdown that's probably going to have the biggest impact on our economy and unemployment numbers in general, because unauthorized immigrants may be afraid to go to work, they may be afraid to report issues at work, and certainly the employers are more hesitant to hire undocumented or unauthorized immigrants in their work places. So the drag on the GDP will probably be there slightly, but it's important to keep in mind that it's expected to be no more than 5 basis points, and that it might impact wage growth and inflation, but in a very modest way. Now, that's not true in certain industries, because there are certain industries where the unauthorized immigrants are a far larger percentage of the workforce. Landscaping, food production, construction or hospitality industry may see bigger consequences. But all in all, it may not be as devastating an impact as we may think. The other change in policy I want to talk about are tariffs. And my gosh, we've certainly seen the tariffs are on, the tariffs are off, the tariffs are negotiated. Now we've got 25% tariff on steel and I guess 10% on aluminum. But the truth of the matter is that tariffs make both imports and domestically produced goods more expensive. So the companies will tend to kind of equalize their pricing based on what you have to pay for goods internationally. So, for example, if you're importing Japanese steel, or you're buying steel from U.S. Steel, you're going to have a similar price level, because that's just how markets work. And why wouldn't a company equal prices that they're seeing worldwide? So it tends to kind of have an inflationary impact on markets in general. But let's take a look at what happened during Trump's first term, because he did impose in 2017 a lot of tariffs on Chinese imported goods. And although they were negotiated downward throughout the course of his presidency, the fact remains that even with the tariffs, both China and the U.S. market posted higher cumulative returns than the rest of the world markets in general. So I think the critical thing to remember here: tariffs, no tariffs, immigration policy, no change in immigration policy or not, markets are forward-looking. And the economic impact of initiatives and policy changes, such as tariffs and immigration policy, are likely already reflected in the market now. These developments, no matter whether they come into play or not, or partially, or they're here one day and gone the next, the effect on markets may not be as dramatic as you anticipate. I mean, the one thing we can count on, you've heard me say this in a million webinars we've done over the years, is that the one thing you can count on is the ability of U.S. companies to find a way to make money for their shareholders, with or without drastic policy changes. I think the one place where changes like this might have the biggest impact, however, is in inflation. So the Fed is still targeting 2%. They're trying to get there, but we're not there yet. The core inflation rate is over 3%. The US general inflation rate is still well over 2%, and the goal is 2%. So right now, though, the economy is strong. Unemployment is hovering around 4%. And Powell, who just spoke to Congress today, said he's not in any hurry to change the Fed funds rate. I mean, right now he feels he's in a really good position and has a lot of wiggle room to react to some of these policies and to some of this uncertainty if he just keeps the Fed funds rate where they are right now. He is in no hurry to adjust these rates, and I don't think anything Congress or the president will say to him is going to change his mind on this. So he just feels that, you know, if he lowers things too quickly, it could have a detrimental effect. If he lowers things too quickly and then we see inflation start to spike again, then we're back to where we started from, and he's going to have to bring the Fed funds rate up. And I don't think he wants to be in that position. I think he'd rather stay the course, watch what happens, and then make the kinds of moves that he can move and make to kind of mitigate some of the changes that may be coming. So before we get into your portfolios, and Leanne's going to talk about that in much more detail than I've talked about so far, I just want to show you the facts about the markets year to date. I know there's been a lot of uncertainty because, of course, what do? We remember those down days much more intensely than we remember the up days. But the fact of the matter is, this is the chart from Y Charts that's fresh off the presses that shows that the S&P 500 is up 3% for the year, and the Russell 2000 is up 2%. So although it may feel to you that the market is doing poorly, I'm afraid it just isn't. It's pretty strong right now. Now, does that mean it's going to continue to be strong throughout the year? This is why I want to show you some research from Morningstar that I looked into earlier today. So Morningstar kind of evaluates and looks over, I'm sure you've all heard of that company, about 700 stocks in the US markets, and their valuations of whether they're trading at a fair value holds a lot of weight. They've been doing this for a lot of years. And what they have found is that currently the price to fair value estimate is at 1.04. Now, what that means is that prices are at a 4% premium based on what Morningstar estimates to be their fair value. Now, 4% doesn't sound like a lot, but here's what you have to remember. It's only happened, 4% or higher has only happened 10% of the time since 2010. So this kind of rich value of equities right now is something that doesn't happen all the time. And so we may it may portend kind of a flat market, or at least slightly downward market for a while until earnings in corporations catch up with the valuations. We can drill down on that even further. And I think this is kind of points to why we don't necessarily invest in individual stocks, but I'm sure you've all heard of NVIDIA and the fact that it has been such a strong stock in the markets over the last year or so. But that news, and this shows you how kind of a difficult situation for some of these companies when you're talking about individual companies, how they can be victims to news stories that come out and have very dramatic drops in prices because something happened in the news cycle, as we saw happened on January 27th when that news about the Chinese new AI platform came out. And believe it or not, the valuation and the market value of NVIDIA dropped 600 billion. I mean, 600 billion, that's a lot of money based on one, headline. Now, is it still there? No, at that time it dropped to be trading at about $118 a share. It's right now, it was last I looked, was back up to 133. But what is important here is you see the price earnings ratio of this particular company. And these tech stocks can't sustain this kind of price earnings ratio and this kind of overvaluation forever. They call it the Magnificent Seven, and I think people are starting to call the S&P 500 the S&P 493 now, because when you take out the high-flying seven stocks, you end up with a PE ratio of 28, which is still higher than the historical average. So I think this kind of speaks about why we invest the way we do. And Leanne's going to get into this a little bit further with you, because you can see a company lose, 600 billion in market value because of one news story. And, this can impact a person's portfolio in a dramatic way if you're invested in trying to bet on individual stocks. So the last point I just want to make before I turn it over to Leanne is this concept of volatility. Volatility this year is lower than average. It's about 8 to 9% less than the average volatility that we expect in the market, which signifies that the market is relatively stable. I know it doesn't feel that way, but the market is relatively stable right now. And, although it feels like everything's changing around us, the one thing that, at least to date, markets are consistent. And there's a lot less fear in the market in general than we may be feeling individually because of changes that have transpired so fast and furiously. So I hope that sets you up, Leanne, for taking us into a deeper dive.
So now what do we do?
Yeah, exactly.
Well, let's talk about some of this as we think about your portfolio and how you're invested. Lorraine, you're going to have to do the slides here. If you
Sure.
can move yeah, there we go.
Go right ahead.
So, look, yeah, so you saw some of the trends in the market. I always like to show this because, of course, we are getting a lot of questions about, should I change my portfolio? Should I go to cash, et cetera, et cetera? And I think it's really, really important to take a long view, of course, of your portfolio, but also look back and see, that markets, I always call this the mountain chart, because the reality is, despite the dips, over time, and this is from 1970 to, I think the date on this was like 20, and maybe even end of January. Oh, no, 2023, sorry. You can see that, we did have times where the market was stressed and volatile because of things happening in the world. And I do just want to point out a couple of places here where they talk about the S&P 500. One was back in the 70s, and I wasn't too concerned at that time because I didn't know anything about the markets. But I was very concerned in 2008, 2009. You can see at the bottom of that Great Recession that all of us on this call no doubt remember quite well. The S&P 500 was down 46%. That was pretty ugly, we know. And bonds were struggling then too, but the bond market wasn't doing great during that time either. But I went back and looked and I said, okay, the S&P 500 was down 46%. What was our 50-50 allocation, asset class allocation? How much did that go down during the same period? What was the low there? And, you would think, well, maybe it was 25%, half, half of it was in stocks. But the reality is it was only down 18. Now, nobody wants their portfolio to go down 18%. But what that says to me, and what I want to remind everybody, is that's diversification for you. We aren't putting everybody only in the S&P 500. We aren't putting everybody only in US stocks. We have that international to ballast. We have bonds. In most corrections, bonds can be helpful, and even the bond side is diversified. So it's really, really important, probably now more than ever, with this volatility we feel in the U.S. market, even though Lorraine showed us a chart where it isn't as volatile as we thought, that we keep in mind the diversification. And we're going to talk some more about that. I always say when people are asking questions right now, what's the one thing, we can control here? Well, first of all, you're not going to spend your whole portfolio this year, hopefully. And therefore, we are so focused on your long-term future that we may come across as discounting whatever's happening today because we don't react to short-term changes in the market. But we do want to also remind you, hey, this is your long-term money. And if it's really stressful that you are stressing every day about things, having enough cash is fine. We've got some clients who are deciding they want to have a year's worth of cash so they don't have to look at what's happening in the market. We have others that are perfectly fine, keeping it in a normal allocation, extra cash of 2 or 3% in the portfolio. So we ask you to really think about that if that pertains to you, and talk to your individual advisor here and understand, what's going to make you sleep at night, help you sleep at night. And having a little extra cash right now isn't bad. We've seen the rates, you put it in a high yield savings account, put it in a T-bill. You're going to be rewarded for having cash. So that's one thing I do want to say. That decision is a personal decision, and we can help you with that. Okay, let's go to the next slide here. We talked a little bit about tariffs and who wins and who loses with tariffs, which can be kind of confusing. Clearly, some of the industries that are going to have more challenges with tariffs, we talked about the steel and aluminum today, but the heavy manufacturing, automotive industry, they import a lot from Canada, I think even from China. Same with the chips in the technology sector. Clearly consumer discretionary, toys, electronics, things that people buy because they want, not because they need. That can, any kind of tariff situation can certainly have some pressure on that industry. But what industries might benefit, in fact, from these tariffs that we're seeing, because they're either producing things domestically or providing services and not reliant on non-US components. Software, the software part of the technology business. Healthcare and pharmaceutical, most of their manufacturing is domestic. Any service providers, they're not necessarily needing to buy things overseas. So these are theoretically opportunities for homegrown companies to really be able to produce and even perhaps have a little bit of price differentiation that would be helpful to them. But the reality is, there was an article, I think last week, interviewing the CEO of GM about these tariffs, and she's saying, "Hey, we've got capacity. We've already been working on this problem, and we've been saying that too. We've known this could come for a while, and companies are really good at pivoting and figuring out where they can get supplies that may not be subject to tariffs." I think GM's a great example because we were fretting that would have a real impact on car prices, and the reality is she seemed to think they would be able to mitigate a lot of that with increasing domestic production. So I guess the other thing too, I'll say on this, we're talking about different industries. We typically have not spent a lot of time in the portfolios trying to design around industries because we are primarily passive investors. We're trying to do broader-based, index-based asset class investments. And so we know all these industries are in your portfolio. However, we do have many clients who come in with legacy stock positions, individual stock positions. And so this is, again, a time to say, okay, we need to take all of this into consideration when we're looking at your individual stocks as well. So we are doing that too on a case-by-case basis. Let's see, what else? Okay, we can keep going here, Lorraine.
Okay.
The tech sector. So here's another chart. We love charts. Just to kind of show you visually, we broke down just the S&P 500 IT sector. And of course, I love looking at price to earnings ratios, just like Lorraine showed you the chart earlier about the Morningstar chart about the fair price to fair value. I look at price to earnings. And you can see back in 2000, if some of you remember that bubble, you can see how high the price to earnings ratio was in the tech sector. I'm trying to see, oh yeah, in February 2000, it was at 47. Now, I'll try and put that in context. The long-term S&P 500 price to earnings ratio that kind of for investors says, okay, this is kind of where things are fairly priced. It hovers around 18. Okay. Yeah, so that's, yeah, thank you. Let's go back to that. Actually, Lorraine, let's go back to that slide just one more minute.
Okay, sure. I saw you talking about it.
I was, yes. And so think about that. 18 and 2000, it was up around 47. The lowest point, which of course was, I think, probably around 08, 09. Yeah, November 08, it was down to 11 because of the correction, the crash, whatever you want to call that. And now here we are, in 2025, back briefly over 40. So again, some of those numbers Lorraine was showing you earlier, with the NVIDIA example in particular, we're seeing some real pricey stocks here in the market. And when we see that, we've been seeing this since the third, fourth quarter of last year. We have started, well, back in November, we did one rebalancing to try and recognize some of those gains and get things back in alignment. We're continuing to watch what happens in this sector because, again, S&P long-term price to earnings 18. I looked up today. Here are the current PE ratios for the Magnificent Seven. NVIDIA still 51.
Yeah.
Tesla, the 136. So when we look at that, we're like, well, why are people invested in these stocks right now? It only has one way to go, truthfully. So that's what we're trying to pay attention to and trying to mitigate by diversifying, by taking the gains, not waiting till we've hit the absolute top, because who knows where that is. And so I know sometimes people have to say, why did you sell? Why did you sell? Well, that's our job. Okay. So let's see. What else can I tell you? Oh, yeah. So not only are we rebalancing, trying to not move away, but reduce overweight in large cap growth, where all those tech stocks are, we also feel it's time now, which we've done this week, to go back into REITs, real estate investment trusts. You may recall we went out of REITs right after COVID because of everybody working at home, the downtown deserts that appeared, high-rise, empty office buildings. Now we are seeing the tide turn. A lot of these buildings at this point, if they may have been refinanced, they may have been sold and bought. So there's a more stable market there. We are also seeing a lot of companies right now mandate 5 days a week in the office now. So these office spaces are starting to be filled. And in fact, the other thing that we're seeing happening is, more and more people are moving into apartments, partly as our population ages, that tends to happen, but also even younger folks who, are having to wait to buy into the housing market because of the mortgage rate. So all of these forces are starting to really make commercial real estate more attractive. It's always a diversifier with stocks and bonds. It does act a little differently, so we like using it in the portfolio when it makes sense. I just put this chart here showing kind of what REITs do after periods where they are depressed. And right now they are still trading at minus 4x times equities. So we feel like there's a lot of growth potential here as REITs start to rebound. Anyway, that's going back into portfolios. So that's another change we're making. Okay, I want to talk about international because I always get a lot of questions about this. Oh, international, never does as well as the US. Well, I'm going to show you a chart in a minute where that's not true. But I did want to talk again about why we feel international is so important in everyone's portfolio. You can see, I know some of these numbers are tiny, but the US is basically, let's say 60%, 61% of world capitalization. That means there are roughly 40% of the world cap is outside the US. Now, we still have a home bias. We're not going to put your portfolio 40% non-US, but we do recognize there's opportunity here and that we need exposure here to have a well-rounded portfolio. I looked recently here and we're allocating right now, we're making sure our international allocation is somewhere between 10 and 20% of the portfolio. And I think that is, again, you saw it in 08, 09. I think we'll see it again. It's going to be a good diversifier when we do have that correction that inevitably comes in a market cycle. Okay, Lorraine, can you?
Yep.
Thank you. Okay, here's why when people think, oh, international never does well. Well, here is a chart I took, I believe, from Dimensional that shows the annual returns by country, who was at the top, who was at the bottom. And the USA, by the way, is the yellow. And so you can start to see that from 2004 to 2023, there was only 1 year that the USA was at the very top of the return calculation. Has it been near the top several years? Yes, of course. But if you start to look down, you can start to see, well, gee, some years it was kind of in the middle. Some years it was closer to the bottom. Even in 2022, it was in the bottom part of the chart here. So there is a lot more help from international than we sometimes recognize because frankly, our news cycle doesn't always focus on that. So we are continuing to keep things in international. Okay, let's keep going. What about bonds? Because I know that's really the question you've been wanting to ask me. So here's the Treasury yield curve. Now, the last time we probably did a webinar and looked at this, it was what was considered an inverted yield curve, where instead of going from bottom left to upper right, well, when you're looking at it, it was very high at the short end and not so high at the long end. And so we have actually seen a lot of flattening out here of the curve, which I think is promising. And I think it will continue to revert back to a normal yield curve where we'll start to see that climb to the right corner. But the nice thing is, I think rates are more stable than they've been. As Lorraine mentioned earlier, the Fed isn't interested in continuing to fiddle with rates right now. They think everything's kind of in a steady state. Well, that's helpful to bonds because then we have the opportunity to get paid to hold bonds at the rates they're at now, and we're not having new bonds issued all the time that are looking better and therefore depressing our bond prices in the portfolio. So it dampens the volatility in the bond side as well. And I think we'll continue to kind of see these kind of rates, especially at the short end, which is great. Okay. Now I have one other very important slide to share with you.
It's coming up. Oops. Here we go.
All right. I promised I would talk about the polar vortex, but I also want to talk about football. So there are some very long-standing indicators of what the stock market is going to do in any given year. One of them is the Super Bowl indicator. And now that we have, where are my notes here? Now that we have had a Super Bowl. And regardless if you were a Chiefs fan or an Eagles fan, you will now be an Eagles fan because the Eagles are from the NFC. And when the NFC wins the Super Bowl, it will be a bull market that year. So that's good news. The other very important indicator that many people look at is called the January effect. And it says, as January goes, so goes the year in the stock market. And you know what? January was up 2.7%. So we should assume the market will do well this year. Now, if you dig into either one of these very carefully, you will find that it's not always true, but we can hope. So keep those two things in mind. Now, 1099s. I want you guys to take out a pen and paper, and I want you to write this down. Not many years ago, a few years ago, the IRS said to custodians and broker dealers, you do not have to get those 1099s out by January 31. You now have a deadline of February 15. And the IRS said, we're going to give you a lot of exceptions to that February 15 deadline because we know that you custodian, you broker dealer are having to wait on information from individual investments. So really, even if you get out in March, it's okay. So I'm telling you this because if you've already received your 1099s, I'm very, very happy for you. If you have not, there is nothing we can do to rush that issuance of the 1099 from Pershing or Schwab. We will be happy to look and see if it's sitting in your Pershing account. We're hopeful that the custodians are letting you know when it's there, but I want to just remind people it doesn't come on January 31 anymore. And we would like to get our own 1099. So we know it's frustrating, but just be patient. You will get it. And we're here to help, but we can't, Pershing doesn't listen to us when we ask for 1099. Okay, finally, the polar vortex. You know, when we sent this invite out, it was very, very cold all across the US and kind of miserable. And so I just wanted to tell you today, actually yesterday in Santa Fe, the high temperature was 54 degrees. So the
okay, now you're hurting my feelings.
Okay, sorry. I forgot that not everybody is enjoying that 54-degree weather. Polar vortex, is in the rear view mirror now for us. So for the final slide, I just want everybody to remember, because these are difficult, emotional times, that this too shall pass. Everybody's
I agree with you, Leanne. It will. We've lived long enough to know.
You're here, and we're now at this point in the webinar happy to answer any questions that you have.
Well, we do have a question, Leanne.
Okay.
Could you elaborate more on how the yield curve works? How does that whole thing work with a yield curve? I think
Yes.
a lot of folks are confused about.
Yeah, I'm sure, especially lately. So
yeah,
typically with bonds, the longer you hold a bond, because you're locking up your money essentially in a bond, the more you would get paid. Okay. So for instance, back in the day, a 30-year bond would, let's say it might pay you 7% a year to lock up your money in a bond. And when I say lock up your money, let's say a corporation is issuing a bond because they need cash. They're going to use your cash and they're going to pay you 7% a year, no matter what, if you buy their bond. And they do that because they recognize markets go through cycles. You could go invest that same money in a stock and maybe make more than 7% over 30 years. Interest rates are going to change and maybe the rates go up higher. And so then now they're only paying you 7%. So in any event, typically the longer the bond, the higher the interest you get for, when you buy it. The shorter the bond, because you're not going to hold it for very long, the less interest you get. But that has not been true in the last 2 years now, where with all this uncertainty with rate increases and then, potential cuts, the short-term part of the yield, or the short-term part of that bond timeline has paid you more to buy a short-term bond than to buy a long-term bond. So that's what they mean by an inverted yield curve. The yield curve's upside down, if you will, and you're getting paid to just hold short-term money. What we like to see is a normal yield curve where if you're going to put money in a bond that's a 10-year bond, you're going to get paid more interest than if you just put it in a 2-year bond. So I don't know if that was really very helpful in explaining, but we like, as investors, we're going to watch that yield curve because we're going to say where are we going to get the most money for the amount of time we have to put it into a bond. And that doesn't mean we're keeping everything short just because those interest rates are, it's at 4.4 versus 4.2. Because we also know interest rates can change. And therefore, even if the intermediate term bond pays 4.2 and the short term bond pays 4.4, we're going to put some in that intermediate term so we can ensure that we're going to have 4.2 for longer. So that's kind of how we're trying to manage to that. And I don't know what else, Lorraine.
Well, I think, no, the main thing about it is that you expect to get a higher yield for a bond you have to hold for a longer time, rather than getting a higher yield for a bond you hold for a short period of time. That the normal yield curve works like that. You might get 2% on a 1-year bond and 3% on a 5-year bond. That's normal.
Yeah, you haven't seen normal in a while.
We haven't seen normal in a while. So when they talk about inverted, that's what they mean. It's not normal. We're getting a higher yield for that short-term bond and a same or lower yield for the long-term bond. So there's no benefit in investing longer term, which isn't typical. So that means it's inverted. It's not normal, I think, is the best way to look at it.
And what I was trying to show there is we're starting to see it turn.
Even out or go back to normal.
Not there yet. So, no changes in interest rates are good for bonds because everybody can kind of figure out what they need, and know what's going to happen with the rates. And we haven't really seen that in the last 2 years.
Right. So another question came in. Could you explain a little more why we're going into REITs right now?
Yeah, so REITs, and think of, REITs, first of all, the REITs that we use are liquid. I know there are illiquid REITs that people sometimes buy. That's not what we're talking about. We're talking about an ETF that holds real estate investment trust, which are invested in many different built companies and buildings in the real estate industry. And we got out, the reason we're going back in is because we actually got out of it. We've used it for many years as a diversifier in your portfolio because REITs can sometimes move differently than the US stock market or the US bond market. And so they're a diversifier. It's like owning a hard asset. If you think of it that way, it's not exactly like owning a house, but it's that sort of diversifier from real estate versus other companies that make goods and services. We got out of it right after COVID or towards the end of COVID because we were seeing that, there were just massive commercial buildings, retail centers, commercial buildings, everything that were sitting empty. And more, people were allowed, people were working at home. They weren't going into office spaces. There was a huge shift in the corporate culture. And even the government culture, the government had really dispersed as well in people working at home. Now we're seeing that shift back. We're seeing more and more corporations and big companies, thousands and thousands of employees realize, I think, that, there is some value to having people in an office, and they are asking their employees to come back. So those office buildings are being rented again. They're getting filled. And so that's one data point. But the other data point is that real estate, and we look at this in all of our asset classes, it went down so much after COVID. The good thing is we got out, it continued to go down. Now we're starting to see it climb back up just from a valuation perspective and an investing opportunity perspective. So it makes sense from a pure investment play to get back in and as it starts appreciating. Now we're talking about an allocation to a portfolio of maybe 3 to 5%, depending on how aggressive your portfolio is. So we're not throwing 20 and 25. It's like 3 to 5% in REITs as a diversifier. Anything else on REITs that you can think of?
I think that was all. Does anybody else have any other questions? You can go to the Q&A button and type a question in. I think that might be all.
Okay, well, we're here. We've been answering these questions for the last couple of weeks, I think since January 21. Yeah, so we're here to answer them and to reassure you. We got one more question here.
Oh, here we go. Can you explain international more?
Yeah, can you? Okay. Well, just the definition, of course, is any company that is set outside the U.S. We typically break up international between international developed countries where the companies are, they're audited, they're publicly traded, there's more transparency, if you will, more stability. And then there is emerging markets. And emerging, by the way, China is considered an emerging market. There's less certainty there. That's the riskiest part of, frankly, of a portfolio is emerging markets because there's just not as much data and transparency. So we primarily use international developed as our non-US stock exposure. And we feel like, just to give you one data point, we keep talking about the US market, the S&P 500, the PE ratios. Well, international developed, they also figure out indices and PE ratios on non-US indexes. And that's around 14. So one reason we like international is because there is more room to grow there and to appreciate than we are seeing in the US market now. US market's overpriced. No matter who the president is, we were saying this last fall, it's overpriced. And when a sector or a market gets overpriced, there will be a correction. We haven't really had it yet, but it's coming. And we want to make sure we're ready. And the best way to be ready is not to be overweight in those highly appreciated tech stocks and to be diversified. And international provides a very nice way to, just like REITs do, international provides a good way to diversify and have some, again, I call it ballast, but like the bonds, when the US market's going down, these other areas should be holding up better.
And we have one more question.
Okay.
What would cause the yield curve to invert?
Well, I think we saw it invert when rates started climbing. And that's when it started. Why exactly? Honestly, I'm not even sure I can answer that.
Well, Leanne, I think it has a lot to do with the uncertainty of where interest rates are going to be and what the Fed's going to do. And I think there's been so much uncertainty about, what's going to happen in the future that the bond markets were just confused about how to price things. I think it's the same reason we're not seeing mortgage rates go down, even though they dropped the Fed fund rate. Because people are still a little concerned about inflation creeping back in again. And I don't think there's that real sense of where things are going to go. And when that happens, weird stuff happens in the bond market.
Yeah. Sometimes, I'm sure if I were an economist, I could tell you exactly why. But it wasn't expected, and what's been really unusual is how long it's lasted. But I
That's right.
think now
That's right.
that we're not seeing that uncertainty in the interest rate cuts and increases, et cetera, that will see
Right.
some normalization there.
S-
Um,
So a couple more questions, and I know we're kind of running up on the hour now, but what kinds of international investments are we making? That was
well,
a
we've been in international all along, and as you
uh-huh.
know, we use a combination of either international uh, passive mutual fund or an international index-based ETF. And so it is going to, well, I'll give you an example. Uh, where did I write this down now? The dimensional international fund that we use in many portfolios, DFIEX, is I looked to kind of see how much was how much exposure did we have to these countries like Canada and Mexico and China. And interestingly, there was only a 0.18% exposure to China in that fund. There was zero exposure to Mexico, and there was an 11% exposure to Canada. So,
Mhm.
which makes sense because China,
Right.
Mexico are still considered emerging markets, and so they are more likely to be in an emerging market fund. But the international developed is going to have a lot of Europe, fair amount of Japan, um, yeah, Canada. But again, it's so diversified that we're not relying on any one country in that international ETF or mutual fund to, there's no concentration, if you will, in any one country.
So we have one more comment.
Okay.
It sounds like you're assuring us that the markets are the markets and daily events shouldn't cause dramatic actions. Is that correct?
Well, uh, to, I do believe the markets are the markets and they will act the way they act, and there are reasons for that. And that's why we see why we perceive volatility when things that don't directly impact the markets are still affecting short-term movements in the markets.
Yeah.
Uh, However, I don't think, we try very hard not to make changes in investments based on short-term events.
Yeah.
No, we've seen it. I showed you that chart
Yeah.
earlier. We have seen that the market could go down and it can go down for a while. But we're focused on the long term, and we know that long term, in especially in the stock market, that it goes up. The equity markets are the only way to stay ahead of inflation. And for the long term, that becomes really critical when we're talking about your long term money. And they come back. We can see this mountain chart right here. It comes back.
Yeah, and Liam, we could even take that, we could have taken that back even further in time through world wars and all kinds of traumatic events that happen, and yet that market keeps on chugging on. So
That
uh,
doesn't mean we're not watching every day and
that's
saying, it's
true.
like I said with the tech, like we're not just going to keep watching that go up. We know it's overvalued.
Yeah, that's why we took some profits in accounts in last
Exactly. Why
November.
we're putting REITs back in. It's why we're staying in
Right.
international. So, so there are, depending on what's happening in the world, yes, you can adjust a portfolio to some extent, but it should be based on, we're data people, right? It should be based on hard data, not on emotion.
Right. I think that's the real takeaway here, is that we do focus on losses. They seem more intense than gains, and we need to keep our emotions in check. At least that's what Leanne and I do, so that we're making sound and clear-headed decisions for your portfolios, even when other events and circumstances may feel very tumultuous at the time period here. So stay the course.
We know it's hard.
We know it's hard. We do, and we understand, and that's what we're here for. Oh, one more question. We have time for one more, Leanne?
Sure.
How much does climate change projection affect your investment decisions? What role does climate change have in?
Well, I think it's a good question. I tend to look at it as on the positive side, meaning what opportunities do we have from an investing standpoint, if you will, uh, for companies that are trying to address climate change. Now, again, we don't invest in individual companies, but we do have an ESG portfolio that has companies in there that are very focused on mitigating climate change. The electric vehicles, solar. So there are a lot of companies who are very much trying to address climate change, and that can be a positive from an investment standpoint. I mean, we've seen our ESG portfolio perform very, very closely to our other portfolios. In the old days, they were, you sometimes gave up return for your socially responsible investing, and that's just not happening now. I mean, we're seeing some really positive returns in that area. That's how I look at it.
Well, thank you very much, everyone, for attending. And if you have any questions that specifically pertain to your individual situation, please reach out to us. We're here for you. We understand. We understand these are kind of difficult times, and we want to answer all of your questions and assure you that, we're paying attention. We've been through a lot, the two of us, at least Leanne and I. We've lived through enough market ups and downs to kind of be able to put it all in perspective. And I know Leanne and I both feel the same way, that, we're here to help. So let us know what we can do. And thank you so much for joining us today.